policy. And he has numerous publications both in China and abroad. So just take a few examples: the review of financial studies, review of economic studies, and international economic review. So I wouldn't, the list go on and on, I wouldn't name all of them. So without further ado, let's welcome Professor He.
Thank you.
Thank you.
Thank you. Thank you. And thank you for the introduction. And I'm so glad to have this opportunity to have an open course called in the title of Reglobalization and Economic Growth for China. And over the past 40 years, China has been an important force for globalization and has experienced very rapid economic growth. And China does and did have benefited greatly from joining the process of globalization. However, at this stage, with a fast-changing external environment, Chinese economy is facing great challenges and opportunities as well. So today, I will cover 3 topics for today's lecture. And first, we'll talk about what happened in the past 40 years about the globalization and how did China benefit from this globalization to promote economic growth. Secondly, I will talk about reglobalization. What's the potential problem or the flaw of the old model of globalization? What new model for globalization should be? What kind of reform we need to do for international monetary system as well as for global division of labor? The third topic, I will talk a little bit about the future of Chinese economy based on this concept of reglobalization. So first, I will talk about the globalization and China's economic growth and its relationship with China's economic growth. So after Second World War, the global economy has experienced very fast development along with the trend globalization. And it has 2 major features. One we call international monetary system. One is international monetary system, dominated by US dollar. This is a simple feature. The other feature, we call it horizontal division of labor, for which we'll explain in a moment. Yeah. Let's take a look at international monetary system first. The international monetary system refers to a series of international rules, protocols, management, arrangement, and organizations that regulate the relationship of different currencies. Usually, it's composed of 4 parts, including exchange rate system, how the exchange rate is determined, and institution for currency exchange, and international currency and reserve assets, and the balancing mechanism of the balance of payments. These are the major components of our international monetary system. Before actually Second World War, we have different monetary system, international monetary system. For example, before 1875, well, roughly 1875, it really depends on which textbook you read. And we have the bimetallic standard system in which gold and silver are used for international payment, not any sovereign currency. And before the First World War, we have the classic gold standard system in which gold was the only medium of payment for international trade, gold. And in between the 2 World War, there is a short period of time we use a system called a gold exchange system, in which dollar, British pound, and gold all serve as international payment methods. And this was the period of time that for the first time, we have sovereign currency served as reserve assets or international medium of payments. And in 1945, actually, the system, we have the Bretton Woods system, which was actually founded in 1944 in a meeting in Bretton Woods, New Hampshire. So we have the Bretton Woods system, and in which dollar become the only sovereign currency for international payment, and as well as a reserve currency. After 1971, there was several tries to recover Bretton Woods system, but was not successful. And then we enter into a mixed exchange rate system. Okay, so I will explain more about Bretton Woods system because that's the system that the major feature of it are still kept in modern exchange rate system. So after World War II, there are 44 countries discussed the design of international monetary system in 1944 at the Bretton Woods of New Hampshire in the United States. And the goal of the meeting was to design a non-gold standard international monetary system with stable exchange rates. Because in the gold standard, every country pegged its currency with gold, with a fixed exchange rate. So you can calculate the cross-currency exchange rate based on their price to the gold. However, every country has an incentive to devalue its currency against gold unilaterally to gain advantage in trading. We call this competitive devaluation, which did occur before the First World War. So now we want to design a non-gold standard international monetary system in which dollar was the only currency for international payment. At the same time, we built IMF and the World Bank. IMF provide liquidity for those countries who doesn't have enough liquidity for international payment. They offer short-term loans. At the same time, the World Bank provide long-term loan for development. It's not providing liquidity shortage for short run. They provide long-term investment for development, for developing countries. So they serve a very different role. So together with the Marshall Plan, Bretton Woods system helped the countries recover the economy and reduce trade deficit because using dollar as a trading exchange medium, and also U.S. trying to help those countries to recover from economy from the war. So the goal of Bretton Woods system is to establish a permanent international monetary organization to promote international monetary cooperation. And make the exchange rate stable, so we have a fixed exchange rate system, and prevent competitive currency devaluation, as I mentioned earlier. So we want to establish a multilateral payment system to promote international trade and economic development. And countries can finance from each other to alleviate a just unbalanced balance of payments, or they can borrow from IMF. So that's the goal of a Bretton Woods system. So the exchange rate system is a key part of the Bretton Woods system. So technically, we have a fixed exchange rate. However, different from the gold standard, every currency is pegged with dollar. And dollar is pegged with gold. So, well, it looks like almost the same as pegging to gold directly. So what are differences here compared with gold standard? Why do they peg the dollar? Anyone want to give a try? What a key issue here. They peg the dollar instead of pegging to gold.
Dollar becomes prevailing transaction currency across the whole.
No. You need to use the microphone. You raise your hand, the microphone will fly to you.
Okay, I think the key issue is that dollar becomes the prevailing transaction currency across the whole world and dominant all the payments in all transactions.
That's true. They become dominant in all the international payment. That's true. But compared with gold standard, what's the difference?
I think you cannot print gold, but you can print dollars.
With unlimited supply of dollar, that's true. But prevent the shortage of the liquidity in the system because dollar can provide liquidity. But why they peg to dollar what's the difference between pegging to dollar and pegging to gold? It looks as equivalent mathematically. Now, the key issue here is nobody, no country can unilaterally change the exchange rate anymore because they're not pegged to gold. If they peg to gold, they can just change my price of gold. But if you peg to dollar, that's a bilateral thing to determine exchange rate. So any individual party cannot change exchange rate unilaterally. They have to negotiate with US about their currency exchange rate with dollar. Oh, that's the trick. Yeah. And also, in Bretton Woods system, there's a mechanism for the balance of payment adjustment. So member states of IMF can use official reserve or borrow. The official reserve could be in dollar or could be in gold, or borrow to balance trade surplus or deficit. Also, the member states can borrow short-term funds from IMF to balance international payment. And only when there is fundamental international payment imbalance can relevant country reset the exchange rates. IMF, the voting process, for voting, it takes 85% of votes to approval. But US holding is definitely more than 15%, so they have the veto rights. Yes. Pavel.
Sorry, Professor.
It's Kadia.
No, it's me.
Pavel.
It's also not Pavel. Guess again. Michael. It's okay.
I'll give your name tag to the lady.
I'm sorry. I'll put it here. So you mentioned that 44 countries attended the Bretton Woods Summit.
Not all of them. Not all the countries. Yeah.
Or they were in agreement, I think, or they met. What percentage of global GDP or global trade volume did those countries represent at the time?
During that time?
Yes.
Oh, it must be very high, more than 2/3, I believe. Yeah.
Because couldn't that system potentially be quite easily circumvented by trading with a non-affiliated country?
But at that time, mostly Western European countries and Europe and those countries, major economies of that time, even though only 44 countries. But international trade mainly occur across those countries. But that's important. Otherwise, we can't call it international monetary system, right? But that's what happened, what the major economic activities occurred in those countries. So technically, US has a veto power for IMF, and US dollar was the only reserve currency. However, you can certainly exchange dollar for gold at any time you want with the Federal Reserve Board. So US dollar is backed by gold at that time. And US actually has a lot of gold at any time. After Second World War, they actually, there was data showing, the data showed that more than 90% of gold reserve are in United States, were in United States. For many reasons, a lot of countries, because of war, they save their gold, protect their gold, secure their gold in US. Also, US certainly make a lot of money during the war. Yeah. And however, using dollar as international medium of payment and as an international reserve currency, over time, in order to meet the growing demand for reserves, US must have a sustained trade deficit. So other countries, in order to gain dollar as a reserve for their own international trade, they have to consistently have trade surplus with US. Otherwise, where the dollar come from? On the other hand, which means US must suffer a sustained trade deficit. However, eventually, when the dollar circulating outside US exceed amount of gold they have involved, and this will damage the market confidence in US dollar in the long run. So that's exactly what happened since 1950s. So in late 1950s, US began to have trade deficit. And in early 1960s, the total amount of US dollar held by other countries exceed the total amount of gold held by US. So the market confidence was damaged because of that. And the US government took a number of measures to prevent the dollar from flowing abroad, and including tax, including other measures as well, besides tax. Also in 1970, IMF created a special journal right to reduce pressure on US dollar. The special journal rights was created by IMF with approval from the United States to reduce the pressure on US dollar, because special journal rights, or SDR, can be used as international reserve assets. So people will want dollar less, then instead they were going to save in the form of special journal rights. At the same time, during Bretton Woods system, there's a theory called the impossible triangle. And equivalently, we call it export inflation. In the sense that a country cannot simultaneously achieve the freedom of capital flow, the independence of monetary policy, and exchange rate stability. Because we know Bretton Woods system is a fixed exchange rate system. So every country tries to keep the exchange rate stable with dollar. At the same time, they want to have free capital flow. Then you find out you have to follow the US monetary policy to keep the exchange rate stable. When US increase interest rate, then the capital will fly to US. And the US dollar has appreciation pressure, right? So other countries, in order to make the exchange rate stable, they also have to raise up interest rate. When US cut interest rate, similarly, the other country has to cut interest rate as well. So that's what we call export inflation when we cut interest rate. So in Bretton Woods system, if US increase the money supply, resulting in inflation, in order to maintain exchange rate stability, other countries have to increase money supply to eliminate the pressure of currency appreciation. And this will result in inflation in their country as well. Export inflation. This already occurred just recently, right? Remember? In 2020, US have a limited expansionary monetary policy. Then it causing inflation globally, not only in US, but also in all major economies who want to keep exchange rate stable with US dollar. Well, they all suffer from the inflation. So which means under Bretton Woods system, major economies who use dollar as major international payment or reserve currency, in order to keep the exchange rate stable, they lose the independence of their money policy. So with these problems, in particular, Triffin paradox, as dollar become more, when US print more and more dollar, and when foreign countries holding more and more reserve currency in dollar, then the confidence in dollar was damaged. So in 1960s, Western Europe and Japan had a huge surplus with their rapid economic growth, and dollar shortage turned into dollar disaster. In early 1970s, the exchange rate of dollar against Deutschmark and Japanese yen was significantly higher than reasonable because they have consistent surplus. These countries have consistent surplus against the US. So the central banks of Germany, actually at that time it should be West Germany, and Japan conducted a lot of intervention to maintain exchange rate stability. However, US did not want to control the currency supply for many reasons. For example, there's a Vietnam War and ideal social plan, they want to print more money, which resulted in severe gold outflow. When other countries make money through trade, they will exchange those dollars into gold. And in 1971, Nixon stock exchange of dollar and gold and imposed 10% tariffs on imports. Imposed tariffs. That's exactly what Donald Trump was doing against China. Well, history repeats itself. Yeah. And, however, it doesn't resolve the problem. So, U.S. still consistently have trade deficit against other countries. So in 1971, they reached Smithsonian Agreement, in which the price of gold was raised to $38 per ounce, depreciation dollar. And exchange rate of all other currency are up 10% against US dollar. Every other country appreciate. And the floating range raised from 1% to 2.25%. So with more flexible exchange rate regime, also dollar technically depreciate. In that way, they think they could eliminate the trade deficit, bring balance of payments into balance. Does it help? Does this resolve the problem? Will this resolve the problem? By depreciation and impose tariffs, like what Donald Trump was doing in 2018. Will these measures solve the problem of trade deficit in the United States? Is my question clear? Come on. you become shy when there's broadcasting. Anyone want to give a try? But the fact is, what happened? You know what happened, right? The answer is certainly no, right? Because you see now, consistently, U.S. still have a lot of trade deficit. Even after so many depreciation or tariffs, they still have trade deficit. But why? Why depreciation or tariffs will not change the situation of the deficit? Anyone want to say something about this? So you can imagine what happened when you depreciate the currency, fixed. So other countries' trading advantage will be weakened, right? Because currency, dollar depreciate. However, the demand for dollar still for payment is still there, right? Because dollar was the only international payment method. So other countries still want to acquire dollar through trading. So what's going to happen is, well, you raise interest rate by 10%. Depreciate against other currencies by 10%, or raise tariff by 10%, whatever it is. Then other country will try to improve their productivity to gain more share in U.S. market to get trading done. Otherwise, they won't be able to get dollar. So actually, this mechanism will only stimulate innovation in other countries to gain more advantage through technology improvement, right? Provide more incentive for other countries. And the US, little by little, will lose their market little by little to other countries. That's why even after Second World War, maybe more than half the manufacturing occurred in the United States. But nowadays, you can see there's no manufacturing. Most of manufacturing is moved away to other countries. First to Japan, then to Ford Jackson, Asia, then to China. Maybe now move to other places. Because everybody wants dollar. There's a demand for that. It will generate more incentive for other countries to gain US market over the long run. And this could be done very quickly. So in a couple of years, again, US start to have trade deficit again. Even in short run, it might lower the trade deficit. But over the long run, maybe not long run, just 2 or 3 years, these firms will come back and with more trading advantage against US, acquired US market. I keep hearing someone was talking in the back.
Sorry, in the short term, it might be effective, but would it not potentially be a stimulus for other companies or other countries simply to increase subsidy rates to export-focused industries? So it creates a
More
almost like
subsidy. Certainly creates incentive for other countries to subsidize their
it's like a
trading as well.
reverse auction. Who can subsidize or tariff the most? Yeah. So,
what's your question?
So how does one address this kind of vicious cycle? Does one just not
you call this
start,
vicious
or?
cycle. Well, good. So Michael mentioned another interesting point. So in order to gain trading advantage, some country might just subsidize their exports to overcome the tariff or the currency depreciation. And this actually, again, lowered the competitive advantage of US. And this vicious cycle, you call this vicious cycle, I think can only be eliminated by abandoning using any sovereign currency as international payment over the long run. You see what I mean? As long as any sovereign currency is used, he will lose their competitive advantage over the long run.
So therefore, we all trade in Bitcoin.
Well, we might.
What replaces that system then?
I will talk about this in a moment. There are many possibilities. Many possibilities. Okay. So you can see, despite the US dollar was depreciated by 10% against all other currency in 1971, but several years later, still they find out the Bretton Woods system cannot sustain. US still consistently suffer trade deficit, and they're still losing gold. Then in 1976, they have the Jamaica Agreement. Technically, in Jamaica Agreement, they abandoned the Bretton Woods system, and they start to use floating exchange rate system. Well, they think, well, maybe we should let exchange rate floating, let exchange rate fluctuation to balance international payment. If you consistently have trade deficit, your currency is going to depreciate until trade deficit disappear. So that's the idea. Also, they tend to have diversified international reserves, but exclude gold. Several major currencies are being in the system, including British pound, Japanese yen, Deutsche mark, French franc, etc. Of course, dollar, in addition to dollar. Diversified international reserve. And also, because now it's a floating exchange rate and the capital is free float, and they introduce international financial market for other countries to borrow from each other. Not just from, originally borrow from government or from IMF. Now they can borrow from financial institution in the international market. The commercial bank, international commercial bank, and investment bank as well. And there's more international cooperation and a policy coordination mechanism, and to jointly adjust balance of payments. So they try very, very hard to bring the trade into balance. They try. However, does this resolve the problem? What happened? We still see, first, let me see if I have the page here. However, exchange rate system was extremely unstable. Now the exchange rate fluctuated a lot. At the same time, international reserve diversification did not materialize. Did not happen. We still have dollar dominating in the reserve system. Maybe euros is the second. What happened? How did US kept other people using dollar?
Just by sheer inertia of the fact that they already have a dollar reserve, right? I mean,
they already have a lot. That's one thing, yeah. And it's very difficult to shift the habit, right? That's one thing. And technically, using one currency for international payment is convenient, to be honest. It has to be convenient. You don't want to, you accept dollar, then you accept euro, then you accept the RMB, then it's kind of messy. So it's actually ideal with one currency for international payment. When you have multi-currency or diversified system, people still will have this market concentrated on specific currency. Then it's still dollar. That's one reason. What are others? Yes. Yes.
Key commodities like oil is priced in dollars.
Petrodollar. They control the petrol trading. The country in Middle East, they have agreement with US. They use dollar for petrol trading, which is needed for every country. Yeah. So every country need to use petrol, oil. So they still use dollar. So you can see why there's so many wars in the Middle East. Well, when there are wars, certainly they need protection from the US. There's a trade, then, well, they will use dollar. So exchange rate was severely controlled by big countries against the interest of small countries. We can see a lot of attack on currency. Southeast Asia crisis in 1997, 1998, and then there's also Plaza Accord, in which Japanese yen appreciated, and also there's attack on the RMB in recent years as well. And also, again, the adjustment mechanism payment balance was not perfect, and the long-term imbalance had not been eradicated. So again, let me repeat, as long as some currencies still, sovereign currencies still remain dominant in the system, and the other country would want to acquire this currency as reserve through trading. For example, if dollar still dominant in the system, other countries still keep dollar as a reserve currency. And they want to acquire dollar. And this creates, then its floating exchange rate is even easier to explain. With this floating exchange rate, you can imagine dollar, besides other demand, there's additional payment demand, right? And reserve assets demand. With this additional demand, dollar always overpriced. Overpriced. When it's overpriced means you will gain disadvantage in trading. Certainly, it will generate trade deficit. So the floating exchange rate is even easier to understand why dollar consistently have trade deficit, because it's overpriced. Probably you already have some experience of buying stuff in the United States and your own country. You feel dollar is always priced higher than purchase power, right? For example, in United States, a bottle of water bigger than this, the bigger one, how much it is sold? How much is sold? $2. In China, 2 RMB. How much you get a haircut in the United States? $20. What's the price of haircut? Men haircut, not women haircut. Women's hair is expensive. But men's haircut, how much you pay for a haircut in China? 50. You go to an expensive store. Usually 30, 40. I think it's regular, right? The regular one. You see, 1 to 2. So purchase power of RMB is stronger than what exchange rate can reflect. And this is very much the case for many currency, for dollar against many currency, because dollar is overpriced, because they have additional demand. I'll explain some more about this exchange rate, how it's determined in a moment. So because dollar with this additional demand for payment, for reserve assets, they are overpriced. Certainly, it would generate consistent deficit over the long run. So here are the facts about international monetary system. First, the dollar at this stage, at this moment. So the dollar is the main reserve currency and international means of payment. And the euro is the second largest reserve currency, international means of payment. And the other currencies are almost negligible. Negligible. And second, the monetary policy of US has impact on the whole world, and the monetary policies of other major economies are not fully independent. Even in a floating exchange rate system, every country still wants to keep the exchange rate stable against dollar, because that makes your trading condition stable with other country. Like what I said, in China, the monetary policy goal, one of the objectives is to maintain the stability of the currency, because that's maintain the trading condition stable. Every other country wants to stabilize exchange with dollar, because dollar is the international means of payment. Of course, you can say, well, we can always ask firms to use derivative market to hedge out the risk in exchange rate. Well, that's demanding too much. Still, the government wants to stabilize currency exchange rate of their own currency against dollar. And with that, US monetary policy will affect their monetary policy as well. And with that, other countries have to follow the monetary policy of US to keep the exchange rate stable. However, the good thing is the US dollar does provide liquidity for the global financial system and does solve the liquidity shortage problem of gold, using gold. Because gold wasn't enough. In particular, with so much growth in international trade, the size of trade is so big. The gold is not enough to serve as international payment method anymore. However, this also gives US financial institutions the power to allocate resources at their own will, right? Because who has the most dollar? Is it ICBC of China, which is the largest bank of China, the world, not just China? Does ICBC has dollar? No. They only have RMB assets. US financial institution, Wall Street financial institution have the most dollar. So they can operate international-wise. And everyone, in order to borrow dollars, they have to go to US institution, which has the most dollar. If they want to allocate capital into certain country, they can just go there and invest. However, on the other hand, for a Chinese institution, they want to invest in a foreign country, they have to exchange their RMB assets with Central Bank of China into dollar, then make investment. And because there's limited amount of reserve assets in dollar, well, Chinese firms certainly has very limited capacity for foreign investment. But this is not the case for US. They have trillions of assets in US dollar. Yes, here's a question.
As you mentioned about the role played by dollar and the advantage of US institutions in the global financial market, it led me to think that maybe technology also play a role, because in the past many decades, most of the cutting edge technologies
was from US.
Yes, took place in the US.
Yeah.
And the product design or manufacturing also took place in the US. But from another perspective, if I have a cutting edge technology, I might prefer to bring it to the US market for financing, to set up venture So there is also an advantage in that aspect, and it can actually feedback to the strengths of
But you're
US
saying
dollar.
US have a well-developed financial market, so people want to go there?
Yes, on one
What's
part,
attracting those technology to?
on one part, many of the technologies that were born out of the US give US dollar the advantage. On the other hand, it also attract more technology advancement from maybe from the globe to the Silicon Valley
So they
by the VCs.
but they do attract intellectuals to work in the United States, right? Because they have a very good innovation ecosystem, right? So smart people would be able to like innovation, have better information, better innovation. Also, their innovation is better financed, can be better financed, right? To gain benefits through innovation. That's true. But why does that have anything with the dollar? You almost get there. You almost get the point, but not yet. The technology is certainly technology advancement in the United States certainly explain the overvaluation of a dollar because they are monopoly in technology. Monopoly means they can sell at a monopoly price. So even exchange rate is overpriced, they can still sell it expensively. So it is because technology does contribute overvalue of dollar. Yeah, you're right on that. Yeah. So here's a number about the weight of reserve currency. You can see the blue line is US dollar. You can see it's about 60%. Right now it's about 58% a little bit. Yeah. And the red line, the dark red, is euro. And it's about 20%. And colorful red is RMB, but it's using the right axis. So it's the right axis. We're not exceeding euro or dollar in any way. And it's only about 2% or something. It's a 2 point something in reserve assets. So we're still small. Yeah. So let's read the case, China's monetary policy in 2022. I believe you have read it before class. So let me state the question. Yeah. In this case, we talk about the monetary policy decision process in 2022. In particular, in the case, it says China did not follow US monetary policy in 2022. Because we know in 2022, there was a huge interest rate rise in the United States because of inflation in the United States. Then the question is, why hasn't China followed the US monetary policy in 2022? And that's the first question. The second question is, what are the costs and the benefits of having a relatively independent monetary policy? Anyone want to give a try? Why did China not follow? Yes.
I think in 2022, China economy and the US economies are in different stage, different cycles. The US was experiencing high inflation. To some part, to certain levels, overheat, tight labor market. But in China, it's totally a different situation with low inflation, with employment.
Why we didn't have inflation at the first place?
Yeah, it probably ties back to what you mentioned earlier in the lectures about over capacity, over investment. That probably has a role, but COVID probably also play a part in damping demand.
Okay. Let Michael say something first. Yeah.
So in 2022, the West was coming out of COVID. And during 2020 and 2021, where there were rolling lockdowns in the West, there was a huge percentage of discretionary spending that went to goods rather than services, which had stimulated demand for China exports. In 2022, as discretionary spending rebalanced, there was a fall in demand for Chinese-made goods. So actually, kind of the Chinese
Also in 2022, what China did is
lockdown.
we have a lockdown.
So it suppressed domestic demand as well.
Also suppressed domestic demand.
So
the
it's
economy is kind of weakened because
So
of that.
it was almost a passive export stimulus for China to devalue the currency by dollars flowing or by RMB flowing into dollars.
Also, why China didn't have inflation in 2022?
Because it didn't give any demand side stimulus, and domestic
The
demand
demand
was
is
suppressed.
weak. Okay, that's one thing. Also, did we actually have expansionary monetary policy in 2020 or 21? No, we didn't. We have some expansionary, but not too much, because we have a very good control on COVID effectively. So we didn't actually need to stimulate the economy with a huge expansion of money supply. Now, certainly, this does not generate inflation pressure. On the other hand, because of the successful control of COVID in 2020 and 21, our supply chain were not damaged. We have a full capacity of production. The supply is okay. The inflation in Western world comes from two things. One is expansionary monetary policy. US, it says we have unlimited expansion monetary policy. And other country, Western country, follow. That's one thing, monetary expansion. Secondly, actually because of COVID, their supply chain was damaged. That's why what you said actually stimulated export of China, because other people cannot produce, but China can. So we do have a very high increase in export in 2020 and 21. And with that, you can imagine we didn't actually have inflation. So in 2022, you can see, well, because of lockdown policy for control of COVID in 2022, there's a depressed demand. At the same time, we didn't have inflation. We didn't have expansion monetary policy in earlier period. So there's no inflation, and the economy is weak. Certainly, we do not follow monetary policy. But what are the costs of doing that? Is that anything unappealing occurred? Yeah, you want to give it a try? Okay.
Maybe two simple ones. One is the capital account have to be to a certain level controlled, so money couldn't get out or get in freely. And secondly, there is fluctuations in foreign exchange rate because
so
of
there
the
are
differentials.
fluctuation. In particular, RMB appreciate or depreciate. RMB depreciate quickly. Other people raise interest, and you didn't change interest rate. Actually, we cut the interest rate a little bit over the past 2 years because the economy isn't doing well. But on the other hand, China dare not cut too much interest rate, because in that way, the exchange rate will depreciate too much further, too much pressure. You might want to say, well, depreciation is not bad because it will improve the trading condition, right? Make your goods cheaper. But why didn't we let the exchange rate depreciate too much?
We have huge foreign reserve.
What?
Reserve.
We have huge reserve, so we don't let it depreciate. But that's what we can. I'm asking why we let it be. We keep the exchange rate as much stable as possible.
Because it effectively penalizes consumption in favor of supply. It suppresses demand in favor of boosting supply. It's just more supply side stimulus into an oversupplied economy.
It was going to stimulate the supply?
Yeah, because it stimulates supply to export potentially. Whereas, so it means you can import demand from other countries, but you don't have very much domestic demand.
It doesn't help domestic demand because foreign goods become expensive. Also, will build into inflation because when there's some factors imported, that's one thing. Yeah, when you can import, when it depreciate currency, there will be imported cost of production if you do have some material imported from foreign country. That's one thing. What else they're concerned? Market confidence about RMB, about economy. What if the market form expectation that RMB is going to depreciate substantially over the long run? What's going to happen? People will stop dump their assets, right? If they expect currency is going to consistently depreciate. And it will cause collapse in asset prices, right? That's a problem. There's another concern. Not many people want to talk about it, is because, well, China and the US are competing with each other in terms of the largest economy in the world, right? When your currency depreciate a lot, then according to exchange rate, your economic size will be much smaller. You're going to shrink. That's exactly what happened. In 2021, when US lower interest rates, monetary expansion, RMB appreciate, and also because Chinese economy grew faster than US economy. In 2021, the size of a Chinese economy is 80%, almost 80% of US economy. But now in 2023, the number becomes 65. Even though real growth of China is higher than US, but they are nominal growth because they have more inflation. We don't have inflation. So the nominal GDP in terms calculated through exchange rate now becomes 65% of US. So it looks like China is falling behind. But that's all because inflation, because exchange rate, So that's something concern that the Chinese monetary authority, when they decide the monetary policy, as well as exchange rate policy, okay? And the second feature I said is horizontal division of labor, or we call it horizontal integration of global supply chain. So according to the theory of horizontal division of labor, multinational corporations in developed economies outsource the processing of some finished and semi-finished products in the industrial chain to enterprises with good processing quality, high efficiency, and a low cost globally, and forming a globalized industrial chain division of labor. So what happens is, whichever place is cheaper, they will move there to produce. That's what we call horizontal division of labor. And what happened is multinational corporations seize the research and development design profit from the upstream of the value chain. And downstream, they seize the sales, settlement, and after-sales services. And with this, they obtain high profits. They control the production service process. But the middle part, the manufacturing part, labor-intensive part, they move to developed countries. Again, they can do this because they have monopoly power in technology, in brand name. They charge very high price for those things, for brand, for technology. And the other part, the labor-intensive part, manufacturing part, has low value added and is sold at low price because it's substitutable. If you don't do this, the other people want to do it. Okay? That's horizontal integration. So over the past 70 years, since the Second World War, there are mainly 3 waves of global industry transfer, inconsistent with the horizontal division of labor I just mentioned. So in 1950s, the transfer of manufacturing industries from United States and Europe to Japan. And Japan experienced fast growth. And in 60s and 70s, we have the second wave. It's from Europe, United States, Japan, to the 4 dragons of Asia, including Singapore, Malaysia, Hong Kong, Taiwan, and South Korea. Sorry, South Korea. I would love to be North Korea. And in 1980s, after China opened the door, so we had the third wave. So the transfer occurred from Europe, the United States, Japan, and the 4 dragons of Asia to China's coastal area, mainly in the Zhujiang River and Yangtze River and the Bohai Ocean region, 3 major coastal areas. In recent years, we do observe some transfer from China's coastal area to the inner land of China, as well as to some neighboring countries like Vietnam, Cambodia. It did happen, but not in large scale. We cannot claim it's another wave yet. We'll come back to talk about this later, in a moment. So what happened for the past 70 years since the Second World War for trade flow and capital flow can be described in the following graph. So what happened is developed country make industrial capital investment in developing country. And developing country make full use of cheap labor and cheap material, natural resource, and export to produce and export. And then after they get the trade deficit, they get money, they invest in foreign reserve to purchase government bond from developed country. So developed country, we call it demand center. Developing country, we call it production center. And developed country has trade deficit, and developing country has trade surplus. Oh, that it describes everything, pretty much. Okay? And this is a graph about the balance payments in major economies, and including both capital account and current account. The current account, the main part of a current account is trade account, trade balance. And so you can see the biggest one is certainly US. You can see here, here is US trade deficit, and trade capital account is this. So they add up to 0, which means they have trade deficit because they borrow money from foreign country, which means capital flow into US. That's why the capital account is positive, okay, because they borrow. Let's take a look at China. Where is China? China is this red line. You can see we have current account consistently positive. 2018 drops to a very low point because trade conflict between China and the US. And 2021-22 reached very high level. But 2023 was a bad year for trade. And let me summarize what's happening, what's the major causes behind the world economic structure. First, West countries, in particular US, largely determine the direction of capital flow and global division of labor. You can see for the first waves of industry transfer, the target country are Japan, 4 dragons of Asia, and China. What are main common feature these countries or regions share? Okay, any thing in common for these countries or regions? Japan, Korea, Singapore, Chinese Hong Kong, Chinese Taiwan, and China mainland. They are what? They are Asian countries, yes. That's not, of course, they have strategic purpose to yeah, in Asia, right? That's certainly one feature, but it's not the most important feature, the common feature they share.
They're all strongly interconnected by sea freight. They're all very coastal, so you can ship goods in and out very easily.
Okay, well, that's ocean country. They have a coast, they have a port, right? Yeah. What else? Most importantly, they have cheap labor, certainly. Good. Young age laborers. Good education. Excellent. What else? And there's a most critical one. They are less development, of course. Yeah. They are politically friendly with U.S. Right? China was the case, right? After 1978, after China, U.S., yeah, they become friends. Yeah. Political. So the direction, the capital flow, and the global division with political preference. I'm glad you didn't say, are they all democrat country with democracy? Which was not the case. And economic tool they use is exchange rate. For China, it's very simple. In order to move manufacturing into China, US allowed RMB to depreciate in 1995 and stay there for a long time. Right? Very simple. Yeah. At the same time, the markets from US and Eurozone countries, except Germany, provide external demand for East Asian countries. I put Germany aside because Germany consistently have trade surplus instead of a trade deficit. I'll come to that in a moment. It kind of very different situation. So they provide external demand for East Asian countries. They open the market for East Asian countries. And certainly generate trade deficits for US Eurozone countries. And because these countries are the country with their currency being international, major medium for international payment, right? So which means they can always print money and consume. They open the market, they actually print the money, consume. That's the case, yeah. And there are many resource exporting countries and most other developing countries, actually they are not active in global division of labor. As I said, the industry only flow into certain country with political preference. And at the same time, US and the European market, the total population with Eurozone and US, what's the total population? US has 300 million people. Eurozone has 500 million people. In total, 800 million people. China is 1.4 trillion people. Oh, sorry, 1.4 billion people. Trillion people, oh my God. We're gonna move to the moon. So actually the market has limits, right? You have 800 million people, but you can't absorb too much of export overall, right? So you cannot open the market to all countries to do that, actually. So they only open to certain country with political preference. That's what happened. Which means old model cannot benefit all developing country. Do you agree with me? Yeah. The old model, you open your market, and I transfer my production to you and purchase from you. They cannot open to all developing countries. And this is already happening. Nowadays, because China is growing so fast. The capacity of production is so big. US and the Eurozone country cannot actually absorb all the capacity from China. And they are already over leveraged because every dollar of trade deficit will become debt of the country, either in the government sector or in the private sector, whoever consumes more. You see what I mean? Yeah. So, however, China anyway benefit from this model. So we depreciate our currency. We start to accept the transfer of the industry, of course, through what we have described, the banking system and the government endorsement. Quickly take on this manufacturing transfer, and the state-owned company move first, and the private firms go after them, and we quickly build our manufacturing sector. So on the supply side, the major driving force is, at least for the beginning, is technological progress brought by global industrial transfer. Brings out new technology. At the same time, because this transfer of manufacturing creates a lot of job opportunities, and we move people from rural area to urban area. We make full use, and this make full use of demographic dividend, because we have a lot of young people who were born in 1960s, and in 80s and 90s they get into the labor force, and mostly in rural area. But they don't have a job if we don't have this open policy. So these two combined together contribute the supply side of economic growth. On demand side, you can imagine at the beginning, the external demand of European and American markets are the major driving force. And of course, associated with that, there will be government investment in manufacturing, government-led investment, not government investment, government-led investment, including manufacturing, and later on, real estate. And we also have infrastructure construction all over the time. But certainly manufacturing was the first drive in demand side in order to take all the manufacturing transfer from overseas. Over time, when Chinese consumers, households become richer, accumulating more and more wealth, they increase their consumption growth. Domestic consumption comes up. And the key words we already discussed is called factor-driven. And I already explained during the past 2 days about how this works in terms of financial system, in terms of government endorsement, etc. This is how exactly it happened. Eventually, we get to this part, then we understand why we did that. Yeah. And we keep the RMB exchange rate low. This is an important policy for China to join the global industrial division of labor structure. We keep the exchange rate low to improve our trading advantage, improve trading condition with cheap labor, and we make the labor cheaper because exchange rate is undervalued to some extent. At the same time, we support dollar because every dollar of trade surplus, we use it, we keep it in dollar reserve. We purchase dollar assets, we make payment using dollar. So this is kind of a trade between China and the US. You open your market to us, we use your dollar. As I said, China benefits greatly from this. There's no doubt about it. We have technological advancement with this. And we fully use the power of demographic dividend, etc. What does US gain from this? he just did this as a courtesy, as a philanthropy work. What does U.S. gain from this?
Cheaper
Goods. For the past 40 years, U.S., except during the COVID period, for the past 40 years, since China joined the Global Division of Labor, U.S. consistently have very, very low inflation, between 1% and 2%. So that's why U.S. still want to keep the low inflation while blocking Chinese goods. That's unimaginable. And after imposed tariff, certainly will become inflation. It will be built into their price. If you constantly increase tariff, their cost of consumption will constantly increase. But of course, it's going to certainly damage the competitiveness of Chinese goods. But certainly will build into, because Chinese goods is the most inexpensive, cheaper. What else do they gain? Who else gain besides consumers of U.S.?
I think U.S. companies and financial institutions,
multinational corporation, because they move to cheaper labor place, right? The production cost is lower. Certainly, they will gain more profits. They will get more surplus value from labor. Multinational corporations. How about financial institutions? What do they gain?
they have they grow in size. They have domination in many financial sectors, and
so they can do business with China by making investment, because now you have big joint market there, and they want to have international trade, and you need to get a finance international market, and certainly multinational corporations need to make investment in China. They all need to use financial services through those Wall Street financial institutions. And all these financial institutions in Wall Street actually become strategic investors for Chinese banks, actually. They do gain greatly from this open policy of China. Yeah. So everyone is happy with this. But this situation, this friendship, this honeymoon ended, I guess, right? Ended because China grew too big. And also China was not very happy either with the division of labor, right? Because we have the lower value added, you have a high value added, you sold your product at a very high price, but my product is sold at a very low price. The GDP per capita in US is 70,000, I believe. Now it's 70,000, is it? 70,000 US dollar, right? Per capita wise. Even more than that, right? Now it's close to maybe 75,000 US dollar. China, 12,000 US dollar, right? Does not reflect this. This is not because of difference in productivity. This is because global division of labor. You are in charge of producing something very expensive, but I'm responsible for producing something very cheap. I will show you in a moment. So the China has a consistent balance in trading, a surplus in trading. And this is the light blue color, the dark blue color. And at the same time, we have the capital account, which is equal to the foreign reserve, sorry, not the foreign research change, foreign reserve change, and the capital flow. Yeah. So now the China's position in global trade is as follows. Let me show you here. This is China. Let me show you here. China is here. In terms, this is the 2023 data. Actually, 2021, 22 is much better. So in terms of export, we have 14%. 2022 was 15%. There's a drop. The export was 14%. import weight is 10.5%. If you look at the US, their export weight is 8.5%, but their import weight is 13%. Their deficit is much bigger than China's surplus. Not much bigger, but bigger. Which means US deficit does not only come from China, but from all the other countries. Another country which is doing very well, I believe, is Germany. You see what I mean? You can see in terms of export weight is 7%, import weight is 6%. Anyone from Germany? They don't speak English? They don't like Chinese food. They eat sausages only. Who can tell me why Germany is doing so well?
Germany is a net exporter of industrial machinery and automotive. That's the foundation of the economy, I thought. And that's why it's so exposed to Chinese domestic demand.
Mm-hmm. The manufacturing is good. Why the other countries, like in Eurozone, like France, you see deficit, right? They're smaller than this deficit. Maybe UK, not in the EU anymore, but deficit. This is major countries, deficit, right? UK, France, deficit. But Germany keep a surplus. But does France have very good technology as well? Also good technology, right? But maybe not as good as Germany. So what happened is in the Eurozone, they only have one exchange rate. You see what I mean? So this reflects average productivity of the Eurozone. And if you are above the average, like Germany, then you gain from this weak exchange rate. If you're below the average, I'm sorry, you suffer from this strong currency. That's why there's a discrepancy. And Germany, besides technology advancement, what else advantage they have? Maybe. Government, maybe. Well, there's a secret channel. Anyone from Russia? Oh, you're from Russia. Good. Do you have some secret deal with Germans? What happened after Ukraine-Russia conflict?
Thank you for your question. After the starting conflict, Germany stopped to buy the
Natural
commodities
gas, commodities
from Russia.
from Russia. And do you see what happened after that?
The price for commodities in
The price go up.
Germany market for commodities grow up.
Someone even bombed the pipe, right? Why is that? Who suffer from that the most? Germans. Another reason Germany has trading advantages, they always can import relatively cheap energy, oil or gas from Russia. So the Ukraine-Russia conflict actually cut off this connection, bombing the pipeline, etc. So now a lot of factory actually in Germany will not have production advantage, cost advantage being in Germany. Where do they move? Do you know? No. Mostly move to US. A small portion of it moved to China. You see, well, this is politics, but economics is always behind it. You need to see this, right? Okay, but it's not the course of politics anyway. So where are we after 40 years of growth? So we can actually summarize the structure of the global manufacturing industry as follows. The first tier, as some of you mentioned, is a global science technology innovation center dominated by the United States. They are the top leader in innovation. every year, nowadays, China can file more patents than US, more. But in some fundamental research and some breakthrough technology, US still far, far ahead of us. The second tier is high-end manufacturing, including European Union and Japan. And third tier is a middle and low-end manufacturing sector, mainly some emerging economies. China is mainly here. Most of manufacturing is in the middle or low-end manufacturing. Of course, the fourth tier is the main resource exporting country. As I said, a lot of resource exporting countries like OPEC, Africa, Latin America, and other countries, as well as many emerging economies, are not very active in global division of labor. As I said, the Western country can only move manufacturing to certain small area. And China is already too big. In order to move to other countries, like for example, US want to move the manufacturing to India, they have to withdraw from China. Otherwise, they don't have enough market capacity to absorb all the production, right? So it's a zero-sum game. That's what they play. Zero-sum game. If someone will gain, someone will lose. Well, what China is doing, as I will discuss in a moment, China is making the pie bigger. Yes?
But Professor, there's still value in doing that.
Oh, please. Yes.
Because in
Particular, what we've seen during the pandemic itself, right? The breakage of the logistics network requires that that the world diversifies its production centers. Otherwise,
there's a risk.
Yeah.
Okay. I'll come back to that. Yes. Very good point. But not through diverting from China. So China is in third tier, and it would take time for China to get into a higher tier. But China, of course, they want to move to a higher tier because it's more profitable. You look at GDP per capita, it's all ranked by this technology, right? US now is 75, and European countries like 50, around 50,000 GDP per capita. Korea, 30, 40, Korea, Japan, 30, 40, 30, around 30,000. China, 12,000. You see the tier? It's all ranked. It's all ranked. Now, what certainly determines how much welfare you can have. Of course, well, this does not completely measure the quality of life, mainly domestic consumption. But it certainly represents international purchasing power of our residents. Certainly will affect the welfare as well, right? Yeah. If you go to a country, everything looks so cheap. You're so happy, right? But if you go to a place, everything is so expensive. I went to the United States. Well, I eat 8 chicken wings and French fries. It cost me $400. Yeah, in airport, 400 RMB. Oh, sorry, dollar, not dollar, sorry, RMB. Sorry. Oh, that's crazy. Yeah, RMB. I automatically transformed to RMB because exchange rate. Yeah, it feels so expensive. But if you go to some less developed country, I feel you like a millionaire, right? You live like millionaire. Everything's so cheap. Yeah. So it matters. Yeah. So that's where we are. So actually, this is a structure of, if you look at the trade structure, you have more information on this. So here, if you look at the information here, China is here. You can see we have upstream deficit in upstream products like raw material, like oil, gas, etc. deficit. But we have middle to low-end manufacturing surplus and middle to high-end manufacturing surplus. But we also have service sector deficit. US is here. You can see the service sector is surplus. All the other parts, deficit. And these are other countries. You can see other countries, they have very high surplus in natural resources. And China, Japan, Germany, Italy mainly export medium and high-end manufacturing products. But China mainly medium. Japan, Germany, Italy mainly high-end. Other countries generally export upstream products. So this is a whole process of globalization, and how does China benefit from that? And where we are, what's the situation? As I said, China benefit greatly from globalization. However, the old model of globalization has potential flaws. I already mentioned a couple of them, right? The dominance in currency generating deficit, consistent deficit, does not benefit all the developing countries, etc. So let's summarize them, the problems along with globalization, the old model of globalization. First, it generates crisis because US and the European market are not sufficient to sustain global economic growth. They keep printing money and consume, keep having trade deficit. They accumulate debts over time and cause subprime crisis and euro crisis. The euro crisis in 2009 was a result of Eurozone country, the government is over-leveraged. Subprime crisis in US, who is over-leveraged? Private sector is over-leveraged. Those poor people, subprime borrowers, over-leveraged. You say, well, how does that connect to the trade deficit? Well, at the equivalent level, yes. As long as this country has deficit, you become his debt, either in private sector or in government sector. And whoever explodes first become a crisis. In Europe, it's just government explode first because aging problem, because overconsumption, etc. But US, because mistake in securitization on subprime loans and mispricing in mortgage-backed securities, etc. This type of problem generating overcapacity in debt, over leverage. But you always reflect it in equilibrium is balanced with the trade deficit. So this type of East Asian production, American consumption model is not sustainable. And because US dollar dominate international monetary system and the euro dominate as well, they don't have enough self-discipline. Whoever can print money to consume will not produce. Simple as that. Even though you want to produce, but the market will force you consume in equilibrium. So any system using sovereign currency as international medium payment will have to suffer this problem. And also the globalization and the corresponding international capital flow have become the tools for some Western developed countries, to exploit developing countries. Plaza Accord in 1985, and make Japan stop growing for 30 years because currency appreciation, too much. And also associated with that, there's a collapse of the stock market and housing market, damage the banking system. That's like, over the long run, exchange rate appreciation kills the exports. Over the short run, I generate a financial crisis to damage the banking system. How harsh is that? And Southeast Asian financial crisis in 1997, and US, some speculator from US actually, trying to attack the fixed exchange rate system in North Korea, in South Korea, in Korea, in Hong Kong, Southeast Asia, etc. It happens to China in 2016 as well. Let me see if I have the case here. That's exactly the case I want to discuss for the next. So I believe you have read the case, so I want you to think about the following question. What are the major factors driving the Chinese capital outflow in 2016? Secondly, why didn't the capital outflow causing asset market crash? Comparing with Japan's performance after Plaza Accord in 1985, what are China's advantages and disadvantages? Okay, since you already read it, so I will just pick on someone. What happened in 2016? Why suddenly there's capital outflow? In particular, actually, the market started to bet RMB gonna depreciate substantially, depreciating from 6 something to 10 to 10, 6.5 to 10, actually break 7 for a short period of time, but it didn't go to 10, certainly. It was stopped. So what happened around 2016 that makes the market believe there is a problem that will cause capital outflow in 2016? Yeah, okay.
Just to start off the discussion, I recall that in 2016 there were speculations about whether the government will protect the housing market or will protect RMB as an exchange in terms of foreign exchange.
Okay. Well, I was thinking Chinese government will have to choose in between these two. So either let the currency depreciate or let the housing market collapse. Is it? But actually it's the opposite. Only protecting exchange rate will protect the housing market. So there's some rumor about that, certainly trying to mislead the government. I believe that. Because it's not either the two. Actually, these two are together. Only we can achieve the stability of a currency, we can protect the housing market.
And so basically there were a sentiment. There was very, very weak market sentiment, especially after equities.
Another microphone. You continue. Please continue. Yeah.
Yeah, very weak market sentiment, especially after the stock market collapse a few months earlier.
Oh, 2015, good. 2015, there is stock market crash. Okay, that's one thing. What else? Yes.
I'm just going back history. I remember 2012.
When you were still a baby.
Yeah. In 2012, the China outbound policy started. Then there was a lot of investment abroad. And then in 2015, there was a dip in the M2 ratio, and the prediction of the M2 was falling below 2 trillion. And that, I think once it hit the 2 trillion, the short-term money supply was an issue.
Remember yesterday I showed you a graph around 2015? A lot of international institutions start to care about the debt size of China. Remember, I showed Standard Charters and the Financial Times, and McKinsey start to look at the debt level of China. What happened then? Why do they suddenly care about the debt? Because they think it's over-leveraged and there will be substantial non-performing loan in the banking system. And also in 2015, Chinese government started the process of deleverage. Remember? Yeah. This information I already told you all the time. So I want you to get to this point, put all the memory back. So when you deleverage, certainly you generate non-performing loans. And because it's over-leveraged over time, and people start to think about the safetyness of banking system in China. So that's the cost, major cost. People start to worry about the banking system of China at that time because of over-leverage, fast growing of leverage since 2009 actually. We see 2009, there was a period of the 4 trillion stimulus plan generating debts. Also, even after that, we have another round of growth, fast growth in real estate, generating debts. And a deleverage, generating a lot of non-performing loans because Chinese government start to realize the problem in the real estate market, trying to stop lending to those real estate developers. Then they're generating non-performing loans. And it did happen. Non-performing loan did happen to the banking system. And what did the Chinese government to do, trying to prevent this capital outflow as well as depreciation of RMB? What did they do? What?
I remember they stopped outbound investment.
They stopped outbound investment.
They started to slow down and
slow down investment. But how about the short-term speculators trading with central bank, trying to force you devalue your currency? What did they do?
There were a number of measures they adopted. First of all, there were direct market intervention, selling of foreign reserve against RMB. There were tightening of liquidity in offshore RMB market to stop short sellers, increase the cost of short selling RMB. There were also reserve charge added on top of buying dollar against RMB flows in terms of hedging.
Margin call.
Basically margin costs. So there were a number of measures
also,
adopted.
they imposed restrictions for individual people to withdraw dollar from banking system, because every individual person technically can withdraw, exchange for $50,000 per year. At that time, we make it become, the total amount is still $50,000 per year, but we said each month you can only withdraw $10,000. You cannot exchange RMB to dollar. But we encourage the opposite way. You exchange dollar to RMB in supporting with RMB. So they fight against it. We fight against it, imposing a lot of restrictions to short RMB. So we won, but at a very high cost. We spent, if you look at the balance sheet of the People's Bank of China during that period of time, the reserve assets dropped by more than $300 billion. Let me see. Yes, 300 billion. More than that. They spend a lot of money fighting against it. Eventually, we defeat them, those speculators. Yeah. So compare with the Japan's performance after Plaza Accord in 1985. What are China's advantage and disadvantage? Japan didn't prevent this from happening, right? They let the currency appreciate first, then depreciate, and the capital flow away freely, right? We have a strong capital control. We don't have a, convertible capital account. Oh, that's the advantage we have. We always have a control. But certainly, the bank has suffered a great cost of spending money to do that. Yeah. That's the advantage of doing that. Yeah. Otherwise, it will be huge capital outflow in expecting the currency to depreciate. Then it will cause collapse of housing market. People will sell their domestic assets, then will causing more non-performing loan in the banking system. Even the collapse of banks in China. Okay. So here's an explanation about what I said. The deficit in trade will it becomes deficit in a debt of a country, either in the banking sector or either in the government sector or the private sector. So the country has a current account deficit, does not have enough money to finance its private investment and a government deficit. That's the idea. So we have this equation holding all the time. The current account balance is equal to net private saving plus government budget balance. The twin deficit says if you have a government deficit, current account deficit, you must have a government budget deficit. So assuming this one is balanced. But in general, these three things should be balanced. So as I said, for US, subprime crisis says consistent current account deficit certainly increase the government debt, budget deficit, but also because of the policy in US about the securitization of non-performing loans and subprime borrowers, they also increase leverage here, causing subprime crisis. But nobody challenged the debt over leverage of the US government at this stage. Of course, people start to be concerned, more and more concerned. Their debt, government debt, divided by GDP is more than 120%. It's very high. For Eurozone, those countries mostly in government debt. Because those countries are small, like in Euro crisis, like Greece, Spain, Italy, the country, the size, economy size is relatively small. When they have heavily leveraged the other market, the investors start to get concerned. So this is the theory behind it. Okay. So let's take a look at debt ratio of major economies. We have shown this before, right? But now we look at the other side of the story. We look at the government debt and household debt. You can see for those countries with high trade deficit will have high government deficit, budget deficit, and high government debt. But you might wonder, why Japan? Anyone from Japan? Oh, many. Good. So tell us why Japan has such large government debt. Japan used to have a lot of trade surplus.
I think the government tried to stimulate the market spending, so the interest rate set very low, like under the 0. Mm-hmm. So I think that's one of the reasons. Mm-hmm. Without thinking about returning the.
Well, you said the exact right thing. Actually, speak to the right thing. Actually, what happened is because after Plaza Accord, the economy is suffering from weakened demand for their export, Japanese export, because exchange rate appreciation. So that there's no enough external demand. So the government want to stimulate the economy. What are they going to do? It's going to stimulate domestic consumption. So they lower interest rate. Also, well, but certainly it's a bad environment because you don't have exports. You lose part of a lot of manufacturing job opportunities, and young people, because trading condition deteriorates and the competition become more intense. Then what happens is, in order to make up the cost rise because exchange rate appreciation, what they do, what the Japanese do, they overwork. They overwork with the same salary, right? Is it right? They overwork. They do out of regular shift, they do extra work without any paid. This actually lowered the labor cost, literally, right? That's one thing. But if they overwork, they don't have time to consume. You see what I mean? Then who is going to consume? Government said, I'm going to consume. They issue debt. You give the money to me, I consume to keep the economy rolling. But that's a bad situation. Yes. I would say. Very bad. Yeah. So yeah, you see how powerful this, we call this financial wall. It's very, very powerful. So that's why a lot of people would actually feel not very happy about some famous entrepreneur in China says 9-6 shift is good. 9-9-6 shift is good, right? You work from 9 o'clock in the morning until the night, 9 o'clock in the evening, then work 6 days a week. This is good. This is not good. working 4 days a week is good. Because that reflects your competitive advantage. You don't have to work very hard, long time to lower the labor cost. You can still trade your stuff, which means you have brand technology advancement, right? To have the monopoly power to sell the goods at a higher price, even with a higher labor cost, you can still sell stuff to other people, other country. So this is only when you work more, only because you're disadvantaged either in technology or in brand name, or in trading conditions. This is all connected. Also, there are problems with horizontal integration. The value added along the supply chain are not equally distributed. As I said, GDP per capita of developed countries are much higher than developing countries. This cannot be fully explained by productivity. It's not that we don't work hard or we are stupid. It's more or less because the monopoly power in technology and in brand name, etc., unevenly distributed. Another problem, some of you mentioned, the global economy is increasingly interdependent. For example, China, by 2018, China has become the largest trading partner of more than 120 countries. And average portion of intermediate goods in total imports of nearly 200 economies from China is 21%, 21.7%, which means more than 20% of intermediate goods from other countries are from China. So which means if China stops production, their production is going to stop. At least 20% of production is going to be stopped. Interconnected. So this reflects the value added difference across different countries. We use China and the US as an example. US take R&D, design, brand. In upstream, in downstream, they take logistic distribution, after sales services, including financial services, as well as production management services. These are all very rich, all very expensive services. A lot of Chinese firms probably have had experience with using Oracle service, maybe. Very expensive. That's what they do, yes. Yeah. But China is in the middle part, production part. Labor intensive and value added is very low. And this interdependence problem are exposed by COVID-19. And because along the horizontal integration, the production is completed by the cooperation of many countries, which inevitably leads to high logistics costs and long transportation time, increasing the risk of industrial chain fracture, in particular during an epidemic or pandemic like COVID-19. At the same time, US, during the COVID, they expand money supply infinitely and transfer the cost of pandemic. Why do we say that? In 2022, US has unlimited expansionary policy, monetary policy, right? Billions, hundreds of billions, trillions of money injection into the system. If China has conducted similar expansion monetary policy, what's going to happen? We're going to experience inflation in China. Simple, right? But when US inject a lot of money into the system, what's going to happen? Exactly. The world will experience hyperinflation because other countries will have to follow US monetary policy. And with printing a lot of dollars, US was able to take more goods from other countries, which means import when print money to consume. And during the period when every other country also suffer from supply chain breakage. So that's why I said it passed the cost of pandemic to other countries. Because everyone is short of production, short of supply. Then you print money to buy stuff from all others. Because only US can do this because everyone accepts dollar. At the same time, US dollar provides liquidity to the international capital market. That's a good thing. But it spreads the impact of pandemic in the United States to other countries through capital flow. So what happened is in 2020, US was the most serious country with pandemic. And you see actually capital flew away or flew back into US. Back to US. This is inefficient. Certainly not because US is safer, but because capital flow is controlled by US financial institution. They want to flow wherever they want. So when US is suffering, they certainly flow back to US. And led to liquidity shortage in other countries. That's what I said. This increases the systemic risk of global financial system and spread the impact pandemic from the United States to other countries. Only they can do this. Yeah. This is a problem. Inefficient capital allocation, transfer the cost of pandemic, too much interdependence of supply chain. That's the old model problem. So a lot of people say, shall we do deglobalization? There's excessive global income gap. As I said, actually you find out because the old model only benefit a small group of countries, these countries become richer and richer, but other countries do not have enough opportunities for development. And the excessive global income gap and the wars have caused flow of population from poor country to rich country. And the refugee problem have brought up discussions of closing borders. And the rise of China has brought pressure to Western countries and triggered trade protectionism and nationalism. And the populist thoughts represented by Donald Trump insist that American and Western developed countries should maintain their leading position in global governance, cultural superiority, and technological leadership. They want you to keep in that way. You stay at a middle and low-end manufacturing with low value added. You cannot advance in high technology. Otherwise, well, the old balance will be broken. So that's what happened. So there's a demand for reglobalization, I would say. Instead of a deglobalization, I would use the word reglobalization, which means we still need to have globalization. The door should be kept open instead of closing the door for everyone, but in a different way. We need to restructure in global division of labor, international trade, with more fairness, more opportunities for other developing countries, more secure supply chain. We need to reform an international monetary system. We need to have diversified reserve currencies and payment methods. We need to have diversified liquidity providers and hedge assets. We need to have more independent monetary policies. And we want to have more efficient capital flows with fewer political concerns. Okay, so how to achieve that? So we're going to take a break. I want you to read the case, reshape the global value chain, thinking about the following questions. Does GDP per capita reflect the difference in productivity across countries? What would be the impact on other major economies if China moved up along the value chain? What should China do about it? Okay? And this also ends the live broadcasting. Thank you very much. Thank you.